All right, so my name is Joey Bunton here at the Tranel Financial Group. Thank you for taking time out of your busy Tuesday afternoon. We appreciate your attendance here and look forward to some good questions at the end. So I guess at this point, everybody who's going to be here has had a chance to jump on, and so we will get right into it. So to start with, you probably have a pretty decent understanding of the basics of what Social Security is, or you wouldn't be here with us today. But Social Security is a government program that is meant to ensure and assist retirement, and also is meant to generally keep track with the cost of living. So it's not exactly the same as inflation, but given our current news cycle, if you understood it that way, that'd be close enough. So a general cost of living adjustment to your Social Security benefit to help ensure that you can enjoy a long and fruitful retirement. Is Social Security free? It absolutely is not free. You have been paying into Social Security your whole working life, most likely, or at least up to a certain point. So you pay for your Social Security during your working years. You pay for it via a payroll tax of 6.2% if you're a W-2 employee. And if you're a self-employed person, you actually pay double that. You pay the employee and the employer tax of 6.2% on income up to $160,000 a year. In the past, that's been a much lower number. It's continuing to increase over the years, and currently it's at about $160,000 a year. So you've earned it. You've earned your Social Security. It is not free. It's not a gift. You've earned it by paying in over the course of your working years. In order to be eligible for Social Security, you need 40 credits. So each year is worth 4 credits. So basically you need 10 years of work experience, 10 years of income in order to qualify for your Social Security benefit. Every time you earn approximately $1,600 to $1,700 a year, you'll earn a credit. So in a given year, if you earn $7,000 or more, you'll get 4 credits. You do that 10 times, you're eligible. You can start drawing as early as age 62, or you can delay those payments as late as age 70, with a stop at the full retirement age somewhere in between. And so your full retirement age, it's an important number to know. It's different based on the year of your birth. Your full retirement age is going to be somewhere between 66 and 70 for anyone who's on this webinar. So if you were born prior to 1954, that would make you 69, 70 or older. You were eligible for full retirement benefits at age 66. If you were born 1960 or later, making you approximately 62, 63 years old right now, your full retirement age is age 67. So again, as we discussed, at age 62, you're eligible. You can take full retirement age between 66 and 67, or delay until age 70. Your 100% benefit is based on your full retirement age. If you took it at your earliest possible date, your 62nd birth month, you'll get 70 to 75%, depending on your year of birth, 70 to 75% of your full retirement age. And then if you were to delay all the way to age 70, you actually get up to 135% of your full retirement age. And then there are other details to be factored in there as well, which we will get to. So things to think about when you're determining whether you turn it on at age 62, you turn it on at age 70, or anywhere in between is, number one, you want to be aware of what your full retirement age is. You want to be aware of what it looks like if you were to wait another month, another year. You do get annual raises from age 62 up to age 66 or 67, whatever your full retirement age is. and then of approximately 6.7%. And then after full retirement, continuing to wait, you actually get an 8% per year raise to your benefit. But there are a lot of other things to consider aside from just your, driving up the benefit as high as you can or taking it as early as you can. One of them is understanding the way earned income works. If you take your benefit prior to full retirement age, we'll get to that in the coming slide. Another thing is longevity. How long have people in your family or people in your spouse's family traditionally lived? How healthy are you? How long do you think you're going to live? There's a break-even calculation that we'll walk through. And then also the spousal consideration, your surviving spouse and the way that benefit is handled. So we'll walk through that later on in an example. But the last bullet point there, the surviving spouse consideration, is when there are a married couple, both drawing a Social Security benefit, and one of them passes away, the surviving spouse keeps the larger of the two benefits. So if planned correctly, or if done in a certain way, you might not lose a huge portion of your Social Security benefit. But if you both have about the same amount, your income could drop by 50%, even though your expenses are likely not to. So that's something to consider when planning as a family what you're going to do with your Social Security benefits. So can you work and draw your Social Security benefit? You absolutely can. And if you are at full retirement age or after, it's unlimited how much income you can earn while also drawing your Social Security benefit. However, if you're drawing income early, if you're drawing Social Security early and continuing to work, you want to be aware of the magic number on here, which is currently $21,240. If you're drawing Social Security prior to reaching your full retirement age, for every $2 of earned income you show above that $21,240, you're going to owe $1 back to Social Security. So if you're earning above that number, 21,240, you're basically working for 50 cents on the dollar after that point. Then we talked about the break-even calculation. We want to take a look at how long will it take to pay off waiting, right? So this isn't, for many individuals, this isn't the most important thing, but it's certainly something to be considered. And in some situations, this is the main thing that you look at. So we're going to look at a situation where a person can take their benefit at full retirement age, which for this individual, we're going to say is 66 years and 6 months. And at 66 years and 6 months, they're going to draw $3,000 a month. If this individual were to wait till age 70, they would be entitled to $4,000 a month. So if they turned it on, they're going to draw for 3.5 years. If they drew it at 66 and a half, they would be drawing for 3.5 years prior to reaching age 70. That difference is during that time, they would be drawing $36,000 a year, which if you multiply that by the 3.5 years, that's $126,000 that they would draw prior to reaching age 70. So if they turned it on at 66 and a half, they would take income of $126,000 before reaching age 70, which is the other age we are considering. However, if they waited until age 70, they would be drawing $1,000 more per month. So if you divided that amount, that in order to find the break even, you divide that amount they would have gotten prior to age 70 by the extra they're drawing at age 70. So that's $126,000 of total income divided by the $1,000 a month of additional income for waiting, and you find that the break even is 126 months, which is 10.5 years. So for this individual, if they wait until age 70, and they live until age 81, they come out on top, because the break even is 80 and a half. When they reach 80 and a half, they've broken even on waiting until age 70. So if that person were to live into their late 70s, they didn't pay off waiting. If they live into their late 80s, they definitely paid off waiting. So something to think about is, how long would you have to live to make up what you passed up on from age 66 and a half to age 70? In this case, it's another 10 and a half years once they turned on their benefit. So working through some examples here, maybe this will get jog the brain a little bit and come up with some questions. We're going to talk about some strategies here. So for Bob and Betty, this top couple here, example number 1, Bob and Betty, they're married, they're both 65 years old. Let's say their earned income throughout their life has been roughly equal, and their Social Security benefits are nearly dollar for dollar the same. If they were to both turn it on at any given age, as they turned it on at the same time, let's say they turned it on at full retirement age, 66 years and 6 months, and their benefits were both $2,500 apiece. That's $5,000 of Social Security income for the couple. If one of them were to pass away before the other, then the higher of those two remain. The higher of those two is $2,500. So their income's cut in half. Their living expenses are likely not going to be cut in half, because you have the same light bill, you have the same water bill. It takes the same amount of gas to get from place to place. Maybe your grocery bill gets roughly cut in half. But aside from that, most other expenses don't get cut in half when one spouse passes. And so you end up with half the income, but more than half the bills. And that can be problematic if your main source of income is Social Security. Excuse me. And so one strategy that you can think about is to stagger who draws when. So in this situation, there's not a big difference between which one of the spouses draws first and which one draws second. But let's say we had one turn on their Social Security at age 62 and the other turn it on at age 70. So you get one that takes the minimum benefit, one that takes the maximum benefit. And over the course of time, or by the time they reach age 70, they'll have roughly the same benefit that they would have if they both turned them on at age 65. But when one of them passes early, the person who turned the benefit that was turned on at age 62 goes away. The benefit at age 70 remains. And so that's going to be much higher than $25,000 or $2,500 a month. They end up retaining much more than 50% of their income, and therefore much easier to continue to meet those living expenses, which again would not have dropped by 50%. Example 2, we've got an early retiree, a woman who is single, retired in her late 50s, currently age 61, not sure when to turn on Social Security. So in this situation, when she retired in her late 50s, let's imagine she did so because she made a lot of money in her working years and she was financially stable. She may not have any reason to wait. If you look at the person's longevity, maybe they have family that lives a long time. Maybe they haven't had such longevity in their blood. There's not necessarily going to be a long train of thought on this. You turn it on at age 62 and she can enjoy that income during the 8 years in between 62 and 70, and during that time not having to draw as much away from her liquid savings that she's built up, and that allowed her to retire early. So it can provide a little bit of a pressure release on the liquid assets, the assets that are able to be spent down by turning on this income source from Social Security. There are many other variables that could factor in there as well, of course, but there are a lot of benefits in that situation to turning it on early. So you may or may not have seen your annual mailer. Every month in the mail, you get something that looks about like this. Not every month. Every year, you should be getting something in the mail that looks about like this. This will tell you, this is obviously not an individual's true statement, but this will tell you right in this area right here where I'm hovering the mouse, what a person's benefit would be at age 62, all the way through waiting till age 70, shows you what you've earned over the course of your working years. That way you can spot any errors, anything that may have been reported incorrectly, and you can go about trying to get that fixed, because that'll have an impact on your lifetime income from your Social Security. And then you can also log in. You have to create a login at ssa.gov. You can go in and you can seek out an estimate. You can seek out this statement. You can get a lot of other really, really good information from the website. That's something that anybody that's got any working credits at all can log into and find. So that is the content that we have for today. I want to open it up for some questions. Jenna, do we have anything?
This is Tyler. We had a question come through. How does this work if a person is on TRS and the other spouse is on Social Security?
That's a great question. So TRS is Teachers Retirement System. It's the Illinois Teachers Pension System, benefit system. And a member of TRS, a person who's paying into TRS, does not pay into Social Security. So on that second slide, we went through, is it free? Or maybe the third slide, is it free? And I said, no, it's not. You pay a 6.2% payroll tax. In the case of a TRS employee, they do not pay the Social Security tax, and therefore they're not growing a Social Security benefit. If that person has other work experience outside of the TRS system, they will be limited by what's called a windfall elimination provision, which is basically means that because they weren't paying into Social Security during a certain period of their working life, or perhaps all of their working life, their Social Security benefit will be greatly reduced from what it otherwise would have been. And the scenario we talked about at the end, where one spouse passes away, leaving the higher of the two benefits, obviously in that scenario, in nearly any, probably all scenarios, the non-TRS spouse will have the higher of the two benefits. When the TRS spouse inherits that higher benefit, the higher benefit will also be reduced by the windfall elimination provision. And so when factoring in, do we let the Social Security benefit run up and run up? Because if I pass, my spouse will then inherit it. In that situation, they would inherit it, but they would inherit a much lower benefit than what it was prior to the spouse passing.
Yeah, and that comes to full circle, Joey. I'm going to read another one here, but I had a client situation a few years back where the spouse was a TRS employee, teacher retirement system. She was still teaching, but all of her credits, except for a select few, she had not been paying into full Social Security, right? So she had not, Illinois teacher had not paid into the system. She was a waitress and so forth prior to becoming a teacher. And she had paid into Social Security. So she would have gotten pennies on the dollar due to the windfall elimination provision. Her husband, who was fully vested into the system, was delaying Social Security on purpose as he was still working and had recently retired and unexpectedly passed away. And, there's never a story that's going to end any worse than this in terms of Social Security, because, that was over $3,000 a month he was supposed to collect and passed away. And since the WEP kicked in, she got a little under $200 a month. So just to put dollars and cents to that, you see how it
WEP
can really
is
phase
the windfall elimination provision.
Correct. Thank you for clarifying that. Next question that we had on here, Joey, could you explain the spousal benefit that allows you to take half of your spouse's benefit instead of your own?
So a spousal benefit allows you to take half of your spouse's benefit. So imagine you take at full retirement, you take spouse one has a $3,000 benefit. Spouse two has a $1,000 benefit. Spouse two can actually take the $1,500 spousal benefit as opposed to their own benefit. So you cannot turn on both. I guess there was a time gone by, but for now, there is you get to turn on one of two benefits, and that's your permanent election. You either get to turn on your benefit, which in the situation I just laid out would be the lower benefit, or half of your spouse's. That is what the spousal benefit is.
So yeah, so what Joey was referring to before was called file and suspend. So after the year 2014, the Social Security Administration outlawed that, right? It was a gray area in the code that allowed you to file for 50% of your spouse's benefit and let yours grow. It was too good to be true, so they got rid of it. But let's go on to the next question here for you, Joey. Could you explain a bit on how Social Security would be taxed throughout the years if you don't continue to make additional income?
So it does depend on, well, I guess in a situation where you're only taking Social Security, in a situation where you're only taking Social Security, there's a solid chance that you're going to be below a certain threshold. And so the lower threshold, you're only paying tax on 15% of your Social Security income. As long as you stay below 40,000 and something, 40 something thousand dollars, maybe Tyler, if you could Google that number, if you know it off the top of your head, you're only paying tax on a small portion of your Social Security benefit. Now, if you have pensions or if you have retirement income from IRAs, certainly if you have earned income from working a job and you go above that threshold, let's say you have a household income of $100,000, you're going to basically pay tax on the majority of your Social Security income in the full boat.
Yeah, so you'll pay up to 85%. So 15% is tax exempt on assets typically over 25,000 of earned income on a joint tax return. I just pulled that right off the IRS website for you, Joey. And we have one more question.
So the 25,000, I said 40,000 plus. So in a married couple, it's 50,000. Is that accurate? So it's gone up a little bit there. Yeah.
Correct. Let's see. Could you go through, this was a question going back to the TRS, teacher retirement system again. And he put it in here. He's a teacher, this person you work with, Joey, in Illinois, doesn't pay into the Social Security system. However, several retired teachers that he knows are receiving some type of benefit that's not anywhere near full retirement. He was just curious if this is what you were referring to.
So that's the windfall elimination provision. That's, some Social Security benefit from working outside of the TRS system, just chopped down to somewhere, maybe it's 30% or even a little bit lower than that off of what it would have otherwise been.
Any other questions that anyone has? Just looking through here.
Let's see. Yeah, I don't see. Oh, so I see one new question that just came in here. If you file at age 61, if you file at 61, does your Social Security increase at 70? And the answer is no. So you're not eligible until 62. So if you filed at 61 to start, right at the end of being 61 to start drawing on your 67 or 62nd birth month, that is what your benefit is. Now you'll still get COLA, you'll still get cost of living adjustment, which is the Social Security's attempt at keeping up with the cost of living. Not quite the same thing as inflation, but again, with the world we live in now, if that's the way you want to look at it, it's close. That's close enough. But that's the only raise that you'll get from there going forward. Once you turn it on, the cost of living adjustment that everybody else gets is the only increase you'll get. Let's see. You're welcome, sir. Okay. With that, I would encourage you, if you have additional questions or if this struck a vein that you want to explore a little bit further, please reach out to us. So you can reach us right here at the Tranel Financial Group. I'll give you our phone number. It's 847-680-9050. Again, 847-680-9050. If you're lucky, you might get to talk to the great Tony Mackey when someone picks up the phone. That's worth the call itself. And he'll help you get onto our calendars so that we can answer any of those questions you may have and, take it even further than that. So thank you for sticking with us throughout some of the technical difficulties. A little bit of a rough start, but that just made the payoff that much better. And hope to hear from you soon. Have a good day, guys.